You're watching the Blockchain Interviews, hosted by Dan Weiskopf. Each episode features interviews with leading industry experts so that viewers can have a deeper understanding of today's quickly evolving blockchain marketplace.
Okay. Thank you very much, Alex Thorn, for joining me in the CEO Blockchain podcast. We're gonna do something a little bit different for folks on this. Alex is his own CEO in the blockchain area. Actually, in all seriousness, folks, we're gonna go into research for a change, which is super cool. Alex, thanks for joining us. You're head of Galaxy Digital's research, and I think it would be very helpful for our audience to get a little educated by you.
Yeah, I'm looking forward to it, Dan. I am head of Firmwide Research at Galaxy Digital, and I've been in this role for 2 years, a little bit over 2 years now, and I was at Fidelity Investments for my whole career, 12 years. 12 consecutive years there in Boston at Fidelity. And, I think going in reverse order, when I left, I was the co-manager of Avon Ventures, which is the early stage crypto VC firm affiliated with the owner of Fidelity, FMR LLC, I believe is the technical way of saying it. And I was director of blockchain research at Fidelity in Fidelity Center for Applied Technology before that. And I had a whole career in legal and compliance primarily. Before that, I started out as a paralegal. Eventually, I oversaw all of Fidelity's forensic investigation for legal and internal investigations. And then I was a senior compliance advisor at Fidelity Capital Markets in Boston. So an illustrious career, but I've really enjoyed being at Galaxy these last 2 years. Quite a great time.
And you have a great podcast. I definitely want to encourage folks to follow your podcast, because candidly I've learned a lot, and especially from your latest ones with Udi Wertheimer, I think pronouncing his name right, and Casey Rodarmer. And you know what, at the end of the day, we really want people to get educated, so please
Absolutely.
tell people where they can hear your rhythm. And by the way, your tunes are great.
Yeah, I make all the music. Dan's referring. I've long been interested in hip hop and electronic music, so I have all this music that I've made. All the beats that we play on the podcast I made, and I also rap the intro usually. That's what you're referring to. But yeah, it's called Galaxy Brains. You can see it on galaxy.com/research. You can also just go to galaxybrains.io. You can just search it on Spotify, Apple, Amazon Music or whatever as well. Yeah, I appreciate that. We love it. I'm actually in our podcast studio, but I'm sitting in the producer's seat right now. It's easier this way rather than on the set that we use.
So you mentioned Fidelity, and I think you mentioned Abby Johnson.
I don't think I said Abby's name, but I'm certainly happy to. Big fan of Abigail Johnson. And she's been into Bitcoin since 2014.
Yeah, no, she was definitely, but she dubbed you, what did she call you? The Bitcoin Viking. Talk to us a little bit about that, and what exactly she meant by the human condition.
Yeah, so Abby gave the keynote address, or one of them, at Consensus, the big conference, which actually is next week, and this time in Austin, Texas. Or I should say, depending on when this podcast airs, it's the last week in April. She gave the keynote address at Consensus in 2017. So it was about May 2017. I think at the time, Bitcoin was rallying just above $1,000 and was what would become that big run to finish the year, ending at $20,000 or so. And yeah, Abby gave a keynote about what she viewed after several years of looking into Bitcoin as barriers to adoption. And I think one of them, she said, the human problem. She said, we're forgetting the human problem. I've actually watched this video a bunch. It's on my website. And she said, the human problem became very apparent to me when we asked one of our employees, Alex, and then they put this, it's almost like a Wall Street Journal stencil of me on the thing, and my friends were like, oh, not enough hair or whatever. It's pretty funny. And what they had done, so at the time I was helping them with a bunch of research on Bitcoin UX, right? So one of the things we did was we went around to everywhere we could that accepted Bitcoin for payment in the physical world. And we did a bunch of experiments. We told them we were doing research. We didn't tell them. We demanded to pay in Bitcoin. We merely asked, like, well, what other things do you offer? I don't know, hey, I forgot my card. Is there anything else I could pay with? Knowing already that they did accept it, but seeing if like the cashiers had been trained on it, right, et cetera. And one of the things we did is we tried to buy something with Bitcoins. We did so successfully. And then if we returned the item, if we said, oh, crap, actually, can I return this item? Like I decided I didn't want it. So I bought like a water, basically. Like a water bottle. And then I said, oh, actually, can I return it? And then it was to try to see if they would offer to refund me in Bitcoin, or if they could, and were they able to? And anyway, but the funny thing is I did get them to honor the return in Bitcoin, the currency I had bought it with. But at the time, this is like summer 2016, the Bitcoin network was being spammed. We sort of suspect and know now that it was by the sort of big blocker camp that eventually became Bitcoin Cash and Bitcoin SV. They were spamming the network, I guess, as for political reasons, to show that it didn't have high enough throughput. But as a result, and we were using, depends on what wallets we're using, the transaction fees attached to the merchant's transaction to repay me weren't high enough. And so their transaction was stuck in the queue of pending transactions. And I waited around for like an hour hoping it might clear, and it didn't. And so and she claims in the video on stage at Consensus that I was totally dejected, and that the quote was, it's like the Matrix. I can't actually use it in real life. Obviously I wasn't totally dejected. I clearly went on to work on Bitcoin and crypto full time. So, but it was and I think she says in the thing that we call Alex the Bitcoin Viking because of and people like him because of their adventurous spirit. She did, I think, caveat, not because, but not the raiding and pillaging part. I was like, thank you for clarifying that part.
You're very brave, I think she was referencing, perhaps.
Yes, exactly. But I've been extremely bullish on what Fidelity has accomplished. I mean, even while I was there, but even in the 2 years since I've left, right? I mean, they've turned on retail buy and sell for Bitcoin and ETH across their entire brokerage complex. They've got an offering in their 401k platform for plan sponsors to add digital assets as an option on a 401k menu. Obviously, they have what they're doing at Fidelity Digital Assets. So they've a lot of progress since then. Come a long way.
They've been very, very forward thinking. And candidly, we should all be thankful for a firm like that, doing what they do, because we've got regulation that we're trying to contend with. And the irony is, if we didn't have a firm or firms like Fidelity to be regulated, we couldn't have regulation. And I know that may sound controversial, but this is the world we live in, right?
Yeah, I mean, they're pushing the ball forward for sure. And they, of course, are a highly regulated multi-service financial company. So to have them out there as the first mover, I think it also gave a lot of cover to other institutions, traditional ones that want to get involved.
Sure.
And they announced Fidelity Digital Assets at the end of 2018. So it's about 5 years ago, 4.5 years ago already. Launched it shortly thereafter, but they've been doing stuff in Bitcoin. They were mining Bitcoin, I think, in 2015, right? So they've been showing the way for a long time.
Yeah, I remember talking to somebody at Fidelity about custody, right? The insurance behind the custody, and that people don't realize the challenge of getting insurance to cover your custody. And to some degree, I don't know where they are now, but it was mostly self-custody at the time.
Yeah.
When I was talking to them.
Yeah, I mean, the market for custody for a long time custody insurance has looked a lot like cyber insurance. And if you look into that market, you'll find that it's really tough because insurance companies have a hard time, modeling out what the potential losses could be. If you look at, there's a famous, right, the Home Depot hack was one of the biggest hacks at the time. And I mean, they ended up so they had losses, real losses. Then they had complaints by customers. So there was litigation cost and judgments and settlements. Then they had regulatory fines, right? And so the cost can balloon. And then, so a lot of the insurance that crypto custodians had and exchanges had, and I'm not super up to date on whether this is really improved, but it was basically on their hot wallet. So that wallet that they used to literally send and receive most of the custodians, then what they do is when that hot wallet balance exceeds some threshold, say what they would need to fund withdrawals during any period, they then sweep it back into cold storage. And the cold storage stuff, as far as I know, for a long time had no insurance. There was no insurance company capable of insuring it, right? So mostly they're those giant policies that you had heard about for exchanges, for custodians. It was really it was sort of like cyber attack insurance on the hot wallet itself, right? And so you can also imagine if you custody $1 billion of Bitcoin in 2017, and like when Abby gave her speech, which they didn't, but if you were an exchange and you did, well, that became $60 billion in 2021, right? Like, so the volatility is also something to contend with.
Yeah. Let's talk about regulation. Expand it a little bit. People talk about the need for good regulation. Exactly what that means, of course, is a question. What are you seeing in the way of regulation in your purview on research?
Oh man, there's quite a lot. Obviously, we focus pretty heavily on the U.S. When we look at and think about and write about regulation. There's a lot happening. It's probably certainly the biggest capital market in the world. I would say it's probably also the biggest crypto capital market, although crypto is quite global. I mean, there's many vectors, right? I mean, some of the things most recently I'm looking at are the SEC custody rule. Where they have a new name for it, but it's essentially an expansion of the custody rule to cover crypto assets specifically. Although many firms were already, pursuing getting licenses from the New York Department of Financial Services to help them be qualified custodians, quote unquote, under the rule. But the formalizing of the custody rule for crypto does have some interesting impacts on prime brokers and trading companies that do so on behalf of third parties, so clients. Actually, before I go into all these, let me give a general thing. You've got the SEC, right, which has a very, I'll call it an activist or very assertive view on crypto. Gary Gensler, the chairman, has said that he believes 99% of crypto assets are actually crypto asset securities. And yet they aren't registered as such. And he's also taken action against exchanges, alleging sort of something along the same lines that, because most of these are securities, it follows that most of the exchanges should be securities exchanges, and they're not. So that whole thing has a giant, series of vectors around it. The question of are cryptos securities or not? The only one that Chair Gensler has said he believes is Bitcoin. There was actually a really interesting exchange between Representative Patrick McHenry from North Carolina, the chair of the House Financial Services Committee, yesterday on Tuesday, April 18th, where Chair Gensler was testifying, where McHenry asked Gensler if Ether was a security. And Gensler essentially demurred. He talked a lot without saying anything, which was interesting because he neither said yes or no. But he had previously said that these determinations require questions of facts and circumstances and law. But he had just previously talked about the law in detail, as well as some of the types of facts and circumstances that might play into it. And McHenry was like, am I to believe that you haven't looked at the facts and circumstances and law regarding the second largest crypto asset? Even though, and I wish he had followed up with, even though you've looked at Dash, you've looked at Algo, Omai's Go, this giant list of low cap altcoins that they in various venues and lawsuits and settlement agreements have asserted are securities. So it's like they have this giant list that's building up of ones where the SEC has publicly said they're securities, either again in a variety of forms. They said so in a civil complaint against Ishan Wahi, who's the Coinbase employee accused of insider trading. You may recall the SEC alleged a giant list of I think 10 or 12 cryptos that they had insider traded, that they were also securities, right? So he's got some list where they're also, a bunch of them are securities, but they haven't spoken about most of the top ones. Of course, Ripple being the other one that they have, right, where they have litigation against Ripple Labs over the issuance of XRP. So anyway, securities law is one big one. And then we have things like AML KYC stuff. You have that both in the US and in Europe. Europe is advancing a bill on AML KYC that would specifically talk about DeFi. You have stablecoin legislation, which is being worked on in the House, which is quite interesting. If that goes well, if that comes out with something that is both progressive and thoughtful and something that companies actually can comply with, but also protects consumers, then I think would be a huge boon to the US dollar.
Yep.
It would also create a giant new marginal buyer of US debt, which in stablecoins, since they are prescribed in that draft bill to mostly hold cash or US T-bills with 90-day or less maturity. And if you follow the global, global fixed income markets, you'll know that sovereigns have for years now been sort of reducing their exposure to treasury bills. So I think could be very positive. Now, if it goes poorly, if it comes out too restrictive that no one can operate, you're going to push that activity offshore. And that's not something we want, because we think America should lead on crypto. We think that a lot about, Bitcoin and other digital assets, the values that underpin these designs and the philosophy of decentralized public blockchains is very in line with American values. And it's something that we can really build on. So we hope that across a range of these issues, they don't go the wrong way. We do see other countries being much more progressive and thoughtful. UK, EU, Dubai, Hong Kong. There's several. And again, these are major capital markets. They're not, backwater offshore, places. That was a lot. I dumped a lot on you there.
It's a lot. And regulation can be, well, let's say it out loud, right? Boring, but it is so important, right? It's critical that we get this right. Which country do you think that Gensler should be paying attention to as an example?
I think, well, I see two approaches. So Chair Gensler is of one mind that the existing regulations, you can force fit crypto into those. That's what he said. I think that's pretty wild. But if you want to do that, you need to do a whole bunch of rulemaking and guidance to clarify how. A great one is the what constitutes possession and control of a digital asset, which is part of the custody rule, right? We know what constitutes possession and control of a security, like that's been understood for years. That's how custodians, like, the big ones like a State Street, for example, knows what it means when they hold a security. That work has been done, that underlying work. The problem is the SEC hasn't done any of the work to explain how, say, broker dealers can hold and trade on crypto asset securities. They haven't done that rulemaking. FINRA doesn't currently allow really broker dealers to hold crypto asset securities, right? So if they're securities and you say you can come in and become a security, even if they were securities, which is, as I said, I'm critical of a lot of that analysis personally, but I mean, let's say they are, like, they haven't done these underlying things that, it's not clear like how an ATS or what the best execution rule would mean for crypto asset security, right? The long list, right? And they haven't done that work. Another country that's taking a similar approach, again, saying our existing laws and frameworks, they work for crypto asset securities, is the UK. But what the UK, His Majesty's Treasury has done, they just published like about a month or two ago, tons of work on this. Here's how the FCA, which is the markets regulator in the UK, the Treasury says in a giant report, here's how they could do custody. Here's how the FCA could amend the execution rules to be appropriate for crypto. Here's how they could do it, right? They're saying the same thing that Chair Gensler is saying, but both at a high level and granularly, they've done all this underlying work to explain how it would fit into the existing system. So technically, I believe FCA still actually has to adopt these recommendations, but they've done a lot of underlying work. The other approach is to create a bespoke framework for crypto, right? And so this is what Europe is doing with the markets and crypto assets legislation, which I'm told by a researcher on my team, I haven't read this one, been following it in the last week, but that it is set for a final vote on Thursday, April 19th or April 20th, which is very likely to pass. So it should come into force, right? And so this is a wholly new regime that is built specifically for crypto, and it covers things like exchanges and other market infrastructure and how they should operate and what rules they have to follow and what reporting they have to do and what transparencies they must have, et cetera. It talks about stable coins and stablecoin issuance, and it talks about literally a whole variety of topics in crypto, and it tells you how to do it in a legal way, right? And of course, it adds consumer protections and oversight and supervision of the entities that do it. So those are the two approaches. I mean, either you start from scratch and you build it up, or you explain and create a transition type of plan for how to force fit it into your existing stuff. What I worry about is that it appears to me like the US is saying the former, but not doing the work.
Yeah, it's Chairman Gensler was believed to be crypto's friend when he, 3, 4, 5 years ago, right? And it just, his door is always open, but it really isn't yet. So we hope he can get it going.
Yeah, I mean, I'm critical of the approach. I'm not going to criticize the intent here. I think, when Chair Gensler was at MIT, we did some work at Fidelity. I was at Fidelity and ran blockchain research, and the digital currency initiative is a big part of MIT's media lab, where Chair Gensler at the time, Professor Gensler, I suppose, also did some work, right? And he's given some great talks in the past about the promise of decentralization and crypto assets. I think for whatever reason, look, I mean, the cryptos, I should say, they're not blameless here, right? We had some spectacular blowups. We've had plenty of bad ideas. I mean, I think keep in mind, these are open source public networks, right? Anyone can build anything. There's no, wait a sec, that's a bad idea, let's deny them to build it, right? I mean, so of course you get plenty of bad stuff too. And I think it's clear the SEC, look, they missed a lot of stuff over the last few years, right? They came in after the fact on the ones that they did come in on, to do something. And, maybe that is fueling a little bit of a pendulum sort of swing in their minds. They feel like now we have to come out real harsh because we missed all this other stuff when it happened.
Yeah, we just want something. I mean, I think at the end of the day, because we just want something at this point, because
Well, we want to be able to operate. For a while, I will say, for a while we had no clarity, right? And that's something the industry has complained about, rightly so, right? They've been saying, tell us the rules, right? Well, I would say lately, over the last year and a half, or even more recently, right? I think the SEC is being a lot more explicit and clear. I think it's just bad. It's built, in my view, on a lot of dubious thinking. I think the force fitting without actually clarifying how it can be force fit, I think is highly problematic.
Yeah. So, you guys wrote a wonderful piece about ordinals and inscriptions.
Yes.
I want to
Appreciate
pivot to talk about what that is, because our audience is mostly financial advisors, and candidly, I think this is a really big deal, and maybe the next leg for Bitcoin particularly, and I'm super excited about it.
Yeah, it's a huge topic. So I'm going to simplify it, and we'll call them Bitcoin NFTs, right? Now, they are different than Ethereum NFTs. I think officially the lingo for the audience, the inscription is, it's like what it sounds like, inscribing. That's how you put the data for whatever the thing is on the chain, on Bitcoin's blockchain. The ordinal is the individual Satoshi, the smallest unit of Bitcoin. The both of these are interesting, but the sort of real revolution was Casey Rodermore figured out, a Bitcoin developer, a pretty well-known one, I guess, certainly at this point, that you could actually take the inscribed data and sort of attach it to the ordinal. Now it does require like an off-chain thing. It's not actually, tokens aren't part of Bitcoin's consensus rules. So this is more of a way that we can all agree to look at the chain. But the end result is, in its simplest explanation, is Bitcoin NFTs, Bitcoin native NFTs on Bitcoin's layer 1 blockchain. And I think it's obviously exciting for a variety of reasons. One is that, the Ethereum NFT market is a giant market, and it was even bigger, of course, but it's, we show the charts all the time, how far trading volume for NFTs has declined since the peak during the bull run, but it's still quite large. And I personally think at the application layer, right? So you've got the blockchains and maybe the assets that power them, like Bitcoin or ETH. But then you've got the things you can build on top of them, some of which may have their own assets as well. But the app layer, I think NFTs are one of them. They're objectively maybe the biggest, if not DeFi is the biggest, and maybe NFTs are second. But we think that they have a bright future. And you think about it like, tokenization as a bigger topic. Can we take, other than, Bitcoin being non-sovereign, deflationary, sound money, digital gold, the promise of Ethereum was, well, what if we could be more than that? What if we could be a gas token to power a world computer? And well, what do you do on computers? You run applications, right? So what will those killer applications be? It's obvious that I think NFTs, even just at their sort of base level as digital collectibles, that's a big market, and we think it'll be big. So to bring that to Bitcoin, it's a bit of a sea change, and you've seen enormous growth in the use of this already. There's like 1.3 million inscriptions. I have my own Twitter avatar is inscription number 10,888. So this is literally, which was on my birthday in February. So this is literally just since basically January, went from like 500 to 1.3 million in April. So huge explosive growth in the creation of these, the tooling, the marketplaces, the wallets and stuff are innovating rapidly. So there were none. And now there's several, and soon there'll be many. And some of the biggest NFT marketplaces have already enabled support for Ordinals. So it's big. It also has a huge impact on Bitcoin itself. And I should mention, it has created a bit of a culture war inside Bitcoin, because there's, of course, a large faction of Bitcoiners who are laser focused on Bitcoin being used solely for decentralized sound money. Right. And some of that, even within that crowd, there's a dispute about whether it should be widely used for payments or whether it should be widely used like digital gold. Right. But both of those camps view Bitcoin as not only best used for monetary purposes, but many argue that it should only be used, and that any use outside of that is essentially spam. Right. You're spamming the network with transactions that shouldn't be used, right? This is a long running debate separately, even before Ordinals, back when Tether was issued on Bitcoin through something called the Omni layer. People were mad about that, right? That was not the correct use. The reality, though, is that these are valid Bitcoin transactions, and unless the consensus rules change in some kind of fork, like you won't be able to remove them. So they're here. But the good news, even if you don't like the NFT, this sort of expanded TAM for Bitcoin that Ordinals can bring, is that these are fee-paying transactions. And so miners love Ordinals because they make more money off of any transaction that pays more money, and these do. And I'm not really in this camp yet, but if some people are worried about what they call Bitcoin's long-term security budget. If you think about it, miners, they build the blockchain, right? And they're compensated through new issuance, literally monetary base inflation, right? Bitcoin progressing to its 21 million final endpoint of total fixed supply. So they get currently 6.25 Bitcoin per block that's mined, and one's about every 10 minutes. That's 900 blocks per day, right? So that inflation pays miners, but also they collect transaction fees. And as you can imagine, quite simply, so every 4 years, the halving, the block subsidy, as we call it, that newly minted issuance halves. So around April next year, in 2024, the per block issuance will be 6.2. So 3.125 Bitcoin per block. And so you can see that their revenues, if the price of Bitcoin is flat and the issuance halves, and their revenues halve, right? So at some point and over time, we should see transaction fees make up a growing percentage of Bitcoin miner revenue. You play that out, till the end, and eventually only fees pay revenue. So there's a large camp of people in general in Bitcoin who believe that fees need to go up. They need to go up in real terms, and they need to go up as a percentage of revenue. And this is something that brings good fee-paying transactions to the network. So it could be good for Bitcoin's longevity as well.
I don't see how it could be bad.
The arguments I'll tell you is that it could price out other more monetary uses, right? And also I will say, although there's caveats here, we go into all of this in this report, by the way, the pros and cons and the various arguments. We happen to think it's clearly a net benefit with minimal negative impact. That's, I would say, the gist of it. But it's that it spams, it adds additional transactions on the network that, by the way, some people are making a subjective judgment, or stupid transactions, they might say, that clog out the space for other transactions. So they make it more expensive for everyone else. That's the primary argument. The other one is that nodes have to store this data that is non-monetary in nature. And that's not what Bitcoin is made for. in this camp's view, and there's some truth to that. They do have to mostly download the data, although some patches have been released you could run on your node to skip downloading it altogether. But this data is crucially, it's what we call prunable. You can run a full node and then discard this data based on, that's one of the things that makes it so elegant from a technical standpoint, is that the data itself is stored in a part of the Bitcoin transaction that nodes don't have to keep. So if you don't want to store JPEGs on your node, you don't have to.
People, well, I don't want to get like spammed, but the Bitcoin mining industry is a business at the end of the day, right? And it's actually on a scalable basis, not an easy business. There's cycles involved with it, and at the end of the day, I think it's moat-like in that it's at the core. You can't have Bitcoin without the miners.
Right.
Now, having said all that, when you look from a research standpoint, when you look at the mining industry, where are their true competitive edges?
Yeah. Well, I mean, if you think about cost, right, for a miner, right, their expenses. So not their, let's talk about their OpEx first, right? They pay for electricity. That's the number one, right? There's some machine maintenance. There's some, some people cost obviously to maintain these things.
Sure.
Maybe they have to pay for hosting if they don't own their own hosting site, data center. If they do own it, then they have to pay to literally keep the lights on in addition to the other, like I guess you could fold that into electricity. But when we say electricity, we're really talking about the electricity that the mining machines themselves, the ASICs, the application specific integrated circuits that they draw, right? That's the primary input, electricity, right? For OpEx. And, on a CapEx basis, the machines are expensive. They have been expensive. They tend to become much more expensive when the price of Bitcoin goes up and become less expensive when it goes down. So you have, and then if you have to buy or build a site, that could also go into your CapEx too. So that's the expense side. I think we have a really good, we have great content on galaxy.com/research about calculating miner cost. We also have a great one on calculating miner revenue, right? And so one way to increase your margins as a miner certainly is to get lower cost electricity, right? In some cases, depending on where you from where you procure this electricity, you can get very low cost electricity, even in some cases negatively priced electricity, right? So that's why we would see, and famously, a lot of Bitcoin mining was done in China. I'll tell you why. It's because the Chinese central government for years built up all these cities they thought people were going to live in, and some people lived in some of them, but there were something like 15, quote unquote, ghost cities that they had built, whole cities that no one ever lived in, literally. And they've been demolishing some of them, but for those cities, they had to build out electricity. And so they built, and they have a lot of hydro in some of the regions where they had done this. So there were a lot of dams built that generated all this electricity and then never got used, right? Like you can't turn the dam off, right? People know how water works. Like you can't stop, the river keeps flowing, right? So they're able to generate this electricity and they have nowhere to sell it. So one of the things that would happen is that Bitcoin miners would set up next to these, remote hydroelectric power plants, and they would buy the electricity, right? And that was either no one would or these guys would. So obviously those dams would say, well, absolutely, we'll take that business, right? But it was very low cost. So you could call this like excess electricity or whatever, but so that's one way. You can also imagine a really interesting one where it gets done. Another way to get lower cost electricity is there's a phenomenon called flare gas mining. When you drill for oil, some people don't know this. I didn't know this for a long time. You pull up a lot of gas. Like it's not just oil in there. There's other stuff in there. And if you don't have takeaway capacity, if there is not a gas pipeline, or you do not have the ability to load up a truck with gas, which is not that easy, especially if a lot of oil rigs are in remote areas, right? And you got no use to it. Depending on jurisdiction, there's rules about how to do this and whatnot, but basically you flare it. If you ever look at an oil drilling site and you see a pipe that has a flame on top of it, that's them burning the gas off because they can't take it away. It's more expensive to take away than to just burn. Literally to destroy it in some cases is a better use, right? So it's the more economical use, right? Or better yet, I mean, flaring it's even better. At least they're combusting it. When you combust what is mostly methane, it turns into carbon dioxide, which is a significantly less harmful greenhouse gas than methane. In many cases, it's just straight up vented, not even, combusted. So it's a long story. Bitcoin miners, though, can say, well, we'll come to your site. Mining doesn't actually, it requires a lot of electricity, but it does not require a lot of bandwidth. The actual data that you're sending to and from the Bitcoin network is pretty small. So there are miners who can mine right off of a cell phone connection. So if there's cellular connectivity, let alone Starlink or something, some kind of, satellite internet, you can mine in very remote locations. Do is you set up a generator next to the gas site. You have them pump the gas rather than combusting it or venting it. They pump it into a gas generator. You combust it. You create a greenhouse gas that is something like 30 times less harmful to the or less greenhousey to the climate. So it's net significantly better for the climate. At the same time, this is otherwise stranded or wasted energy. So oftentimes the cost of it is significantly lower than, say, buying electricity from the grid. So that's a long answer, Dan, but that's just one, right? So that's just ways that you could improve your electricity consumption side of your OpEx. There are even more in Texas, for example. They have a very deregulated energy market where you can prepay up front for a bunch of electricity. And then if it becomes too expensive, you can sell the electricity back to the grid rather than using it yourself. And there's whole markets there where miners can get very creative with their energy trading and hedging strategies to also reduce the cost of their electricity. But there are other interesting things. Just real quick, you can improve the efficiency of the ASIC machines themselves. You can underclock them, overclock them, get them to a place where the margins are best, right? Where they draw, say you can underclock it and draw 50% less power, but you can actually still get 60% of the efficiency out of the machine. So you're increasing your margins. You can put the machines into liquefied cooling vats, giant vats of liquid that keep them cold. You can run machines underwater. I mean, I guess that's something you can do. I didn't know. I don't think it is water. It's some kind of coolant that can make the machines more efficient and also use less energy than cooling the entire facility with air, right? So there's a variety of technical things you can do. You can use different software on the machines themselves that makes them more efficient. There's quite a number of vectors for, depending on how innovative and talented the mining team is, that they can suck more efficiency and margin out of that mining business.
So Alex, have you tried the coolant before? I tasted it.
Did you?
Yeah. Call me a little bit crazy.
Haven't.
Yeah.
I've actually never been to a liquid cooled mining site myself. I've only been to ones that use fans basically to cool, and they're very loud. Another thing to point out, one of the criticisms you hear about Bitcoin mining is that they're very loud, right? And that I've read articles. I've never experienced this. I've been to giant ones. They're loud when I'm there, but I didn't hear it like a mile away the way I hear, but maybe some people do. But liquid cooled mining sites are silent pretty much. So that's another byproduct.
And you didn't talk about renewables too, right?
Well, that's right. I mean, yeah, well, especially with stranded energy, this is a great example too. I mean, I talked about the flare gas, which is, sort of remote. It's very remote, right? Literally far away from stuff. And there's a lot of renewable sites that also don't have takeaway capacity, right? You could say, wow, we could look how windy it is over here. We could build a bunch of we could build a wind farm here, but we've got there's no power lines, right? And I'm sorry, people don't realize this, but the battery industry is not sufficient at this point, the quality and size of batteries to store entire grids worth of electricity, right? And even then, you can imagine if I find a remote, plain or plateau where wind is great, okay, so now I've blown all day and I've filled up my batteries with electricity, how do we get it somewhere?
How do we get it? Yeah. No.
Yeah. So there's a lot of, and that there's some truth to this about solar. There's also some hydro is like this as well, where there could be great renewable energy projects, right? That maybe hope that one day will be connected to the grid where they can truly benefit businesses and entities and whomever, any other. But today, maybe it's not planned to be built out for 5 years, but the capital and interest to build it is now, right? So you could build it there, have Bitcoin miners, buy it from you. They don't care. They don't need to be near the grid. They don't need to be near a city, right? It's a global decentralized internet network. They just need internet. And they can essentially provide the free market demand to purchase that new renewable supply. And that can keep the renewable energy operator solvent or profitable until the point at which it can be connected to the grid. So and by the way, once it is connected to the grid, then if there's no demand from the grid, well, then bam, Bitcoin miners can turn on and take that demand, right? And so this is in general too, that whole notion that Bitcoin miners are, I think they're the most nimble large purchaser of electricity in the world, right? So they can turn on and off at a moment's notice. So they can simultaneously create the demand to fund the build out of new energy assets, whether renewable or otherwise. I mean, any type of energy asset. But when some other buyer of more urgency or who will pay more or whatever it may be comes along, they can just turn off at a moment's notice. And now you've got a giant new pile of electricity that was built out for one reason, but can be additive for others, right?
They make the grid more efficient. I mean,
they do, and they make it more stable, right? They make it more resilient. They are funding the build out of energy grids. Yeah. And by the way, I mean, it's not just like, you remember there was the terrible storm in Austin, Texas, like several years ago, and they had a blackout. Like, it's not just there. And by the way, Texas's grid has become much more resilient over the years. And I would dare to say part of that is by adding these large flexible loads, Bitcoin miners to the grid in size. But my mom lives in the Northeast. I grew up in Boston. The grid is terrible there. There is a story. Luckily, this winter was super mild in general, but there is a story every like Thanksgiving in newspapers all over New England where they point out that like New England's grid is completely like on the brink. Like if there's more than 2 bad storms, like the grid is not going to hold up. You're going to see rolling blackouts. And indeed, there were blackouts this past Christmas. My mother lives in New Hampshire on Christmas in New England. I mean, and that part of that is because they've refused to build energy transport. Like there's going to be a pipeline. Upstate New York has one of the largest deposits of natural gas, and they're going to run a pipeline to Boston. And I don't know why, but that pipeline was opposed. I think the word pipeline sounds scary to some environmentalists, but never fear. We're supplementing our need for natural gas by buying it from Portugal at like 10 times the cost and having it shipped. I don't know.
Go figure.
I don't know why.
Yeah.
So I'm just saying, like, these energy grids, they need to be robust. And one way to do that is to add large flexible loads.
So changing the subject a bit, because you've got experience as a venture capitalist, right? Talk to us a little bit about what's happening in the venture capital world around blockchain. We had massive amount of money go into venture capital last year, and now in this first quarter it's subsided, right? Are we bottoming perhaps on the flows? I can only cross my fingers, right?
Yeah, it was, I think 21 saw $33 billion allocated to, or I should say invested in crypto startups by venture capitalists. And I think 22 saw about 30. So these were 2 massive years. If you look at it quarterly, it's actually, you can see it went up. I think the top that I have it is is Q1 of last year. So 2022 first quarter was the biggest. It was like $15 billion in one quarter allocated. This quarter one that ended in March, about a month ago, only 2.2 or 2.4 billion was allocated or was invested. I keep saying allocated. And the reason I keep catching myself is because we look at both sides. We look at fundraising by startups, so investment in startups. We also look at fundraising by funds, so allocation to venture by large allocators. And that was also down pretty big. 2.2 billion raised by 14 VC funds we calculated in Q1 of this year, also down significantly from prior quarters. So it's a downtrend right now. I don't know if we've bottomed, Dan. We haven't come up yet. So like Q1 was still lower than Q4 of 22. So hard to say. I think it's possible we have. And one reason is because venture activity in crypto tends to follow crypto asset prices a little bit. And I always put at the top of our reports on this chart that I do where I take the quarterly invested in crypto startups as a bar chart, and then I overlay the price of Bitcoin on it. And you can see pretty clearly that like there's some correlation there. And of course, we've rebounded quite robustly in liquid crypto asset prices in year to date in 23. Right, we started the year at 16.6 on Bitcoin. We're at about $30,000. So it's almost a doubling It's like 80%. And so you could see more activity come this year. If you don't, we're on pace for like 12 billion invested, which is, it's not bad. I mean, that's significantly above where we were pre 2020 and 2021 and on any year, right? So it's still a higher low, I'll call it, right?
Yeah.
But at the same time, keep in mind, you've got, other forces pushing against venture broadly, namely the cost of capital, which has come up significantly, right? So those allocators themselves, I mean, I think the financial advisors that listen to your podcast will understand this well, right? Years of zero interest rate policy had pushed them far out on the risk curve in terms of their own allocation. And so that we saw huge venture funds raised because there was demand for yield essentially. And they do the math on quality VCs and they can return massive amounts of capital sometimes, right? A couple big hits and you're just huge, right? So I think whereas now, I mean, you can park your cash in a money market fund and earn 4+%. Like, it seems like, well, is that enough? I don't know. You've seen declining interest in VC in general from allocators. So I think and then of course, throw in the crypto turmoil, call it the crypto turmoil of 2022, all the boondoggles that we saw from, that chilled, I think, some interest. You saw there were some allocators, for example, some big pensions in FTX, right? And that's a spectacular blow up, right? And so you can imagine in those investment rooms, in those investment committees, like saying when they see a crypto deal, perhaps as a direct or a new fund is trying to be raised in crypto, in some of those investment committees, that those aren't going, there's still a bad taste from some of the investments that were made last year. So that's a lot. I mean, I think you still see a lot of interest in trading, exchange, investing type companies, market infrastructure companies. You see a lot of interest in Web3 related stuff, which I typically calculate as DAOs, NFTs, metaverse, and gaming. Lots of interest. I mean, lots of deals getting done in those spaces, but lower valuations, lower deal sizes, and fewer deals than the bull market, which I think is to be expected. I don't think there's anything weird about what we're seeing. I think you'll see these crypto markets have been like infamously or historically cyclical. I think there's no doubt in my mind we'll be back in crypto. We will see new all-time highs in crypto assets. There's no doubt in my mind. I don't know when that is. That's obviously the, $1 million question. But no doubt VC will follow.
Talk to us a little bit about volumes in trading, because the way I look at it is it's what we've gone through is the point in time where people stop being involved and stop trading in, I'm going to say Bitcoin as an example, right? And then boring became a reason for things just to naturally lift. I think somebody said it was something like there was trading volume of 20 billion a day, went down to 10 billion, right? Where are we today? And can you envision a catalyst where things really rebound again? And what would that be?
Yeah, great. It's a tough question, volumes. I typically rely on a few sources for this. The reason I say it's tough is because this is an extremely fragmented global market. If you trade a common equity, it's probably like on NYSE, right? You can go and see the volume. Like everyone who trades it technically will trade it mostly through NYSE, right? Or whatever stock exchange, it's listed on. And then of course we have a large OTC footprint in crypto, lots of private trades happening. It's down, volumes are down. Retail tends to use exchanges, crypto exchanges, which I would say is an interesting quirk of crypto markets, largely give their data away for free, crypto exchanges, whereas, data is like a prized possession in the traditional financial world. So they're down, definitely. But Bitcoin and ETH are still quite liquid. They are the number 1 and 2 by both market cap and liquidity. So Bitcoin is number 1 most liquid and the biggest market cap. ETH is the second biggest market cap and the second most liquid. So, and you can move in and out of these things for the most part in size. So they're still liquid enough for pretty chunky allocations. But I mean, it's come down a lot, and obviously, several blowups have reduced the amount of liquidity available, both because of their funds, but also venues have gone offline, right? That make it a little bit less liquid. I think, I think, as one thing that would bring more liquidity, obviously, is more regulatory clarity. That would get institutional investors more comfortable investing and using these platforms, or whatever, you trading them wherever they are, allowed to trade. In general, though, I think it's pretty clear. I mean, as market cap goes up, liquidity increases, right? It becomes less volatile, becomes easier for large allocators to be interested. When I'm talking about pensions with like hundreds of billions of dollars under management, right? That's, when I say it's pretty liquid, I don't know what market depth is right now. Keiko, a data company, publishes great data on this. But what is like 2% market depth? It's like I'm just looking at a chart one of their analysts posted recently, and it's like, it's lower than it has been. It had been as high as 12 or 15,000 Bitcoin you could buy or sell without moving the market 2%. Now it's down to like 5,000 Bitcoin. And, so that's big for some people. But, not if you're $100 billion pension, $200 billion pension. Now, of course, market infrastructure has improved. You can trade over time. You can do TWAPs. There's algo trading, right? There's ways to do it. You can do it off, on over the counter, so you don't hit the exchanges and don't move the markets in that way. There's plenty of strategies to get in and out in size, but volumes are down. I think, until retail can really come back in force, and until we get more regulatory clarity. But again, keep in mind, like I mentioned this at the top, there are major advanced capital markets worldwide that are providing that clarity now. And the US is important, but it's not all the money is in the US, right? There's many people worldwide who love Bitcoin, and they're involved or looking to get involved. And it's about to get a lot easier for them to get involved from a regulatory standpoint across the world.
Yeah, I think here in the US, I think often we forget, or maybe not we, but certain people forget,
For sure.
that we can speculate on Bitcoin and digital assets, but Bitcoin and digital assets are needed in certain countries. They solve a core problem, and so it is not going away.
Yeah, I agree. I'm speaking at CoinDesk's consensus conference. That's 3 seasons in a row there. And the title of I'm doing a panel called Bitcoin and Inflation. It's complicated, and I'm sort of offering the more markets related view here. But the other panelist is an Argentinian who, by the way, Bitcoin was at all-time highs. I don't know if today it is, but in Argentinian peso terms, right? So there's, and of course that country has dealt with, multiple massive inflation events, collapses of their currency, et cetera. So, the bull case, the usage of a non-sovereign, unseizable, immutable, and even deflationary internet native money the picture looks a lot different if you're in Argentina or Lebanon or Ukraine even than it may if you've got like Apple Pay and you're like, got no problems in the US. Although I will say, the banking crisis in the US, which has been neatly papered over by the discount window and the BTFP, right? The ability to just say, wait a second, all the banks can just have some free money and that'll solve it, right? I mean, I don't think people realize just how fragile the US banking system became with Fed interest rate policy. And so I think Americans are waking up a little bit more to the fact that, wait a second, we might not always be able to take, the resilience of our bank accounts at face value. So there's been a little bit of that, but obviously in the US in general, most people have access to good, high quality, safe financial services, but recall that much of the world doesn't. But they do have smartphones and they do have the internet. They can learn all about Bitcoin, right?
So this brings me to the last 2 questions that I always like to ask. And they're wild card questions. So
Okay.
the first one is, what is the one thing that investors in the blockchain are not paying attention to right now that in hindsight is going to be so obvious?
Yeah, this isn't maybe that exciting of an answer, but payments. No doubt, I swear to you, public blockchains are significantly better. You talk about you want we used to say, I looked at all these blockchain use cases at Fidelity, we looked at 40 or 50 or use cases for blockchain. So not crypto, not native Bitcoin stuff. What else can we do with the blockchain? Of course, at Fidelity, because we're a financial services firm, we mostly looked into things in our business processes, right? trade settlement or, sharing KYC information in a private and confidential way or whatever. And almost always the reason why there were a couple reasons why it wasn't a good idea or wasn't yet ripe. So we would set triggers for these things to change. Then the idea could become interesting, but it was the blockchain wasn't solving the problem that there was. It wasn't the right tool for the job. Actually the problem was the problem itself was different, right? It was a data standards problem, for example, or something else. There were entrenched intermediaries who, would oppose it because they profit or have some incentive that didn't make them want to upgrade to this new technology. Or the third one, I think that people forget about is that it was too costly to upgrade, right? And so what we say is it has to be a 10x improvement, right? Same thing in venture. When I look at companies, like, all right, this is cool, man, but we're really going to get people to switch off taxis. Is Uber really a 10x improvement? Well, we know it is, right? So 10x or 100x. I think payments are 100 times more efficient, faster, cheaper, safer on a public blockchain than they are in our current system. And they're significantly more efficient. Now, that I don't just mean Bitcoin, I could mean stable coins as well. I think that's something we're realizing with stable coins, one of crypto's true killer apps. But they're global, they're fast, they're auditable, they're actually highly traceable. This idea that Bitcoin's good for crime, it's simply not true. If you talk to, and I did some work at Boston College's graduate program of cybersecurity and talked to some federal agents who do cyber investigations, they will tell you that Bitcoin investigation. We had Chris Tarbell, the former FBI special cybercrime agent, who locked up Ross Ulbricht, the founder of the Silk Road, the illegal darknet marketplace. You may recall, he did that investigation. He was on our podcast Galaxy Brains a couple of weeks ago, and he said this also. It's different than doing a traditional asset investigation, but you can get a full topography of the entire payment history. Like, it's right there on the blockchain, public for everyone to see. Now, it doesn't have people's names attached to it, right? But if you can come by those by other means, you have an incredible paper trail to look through. So it's auditable, it's fast, it's transparent, it can be cheaper. Bitcoin's Lightning Network is like fractions of a penny per transaction, and it's instant. It's called Lightning for a reason. It's like, bam, paid, instant, faster than a credit card swipe. So I think this is going to be huge. By the way, David Marcus, former PayPal executive, former head of Libra at Facebook, later called DM at Meta. He just they just rolled out. People were wondering what he's been working on. He started a Bitcoin Lightning payments company called Lightspark, and they just rolled out their product like last week. You can go to lightspark.com and see it. And it is a payments as a service company built on the Lightning Network on Bitcoin. So I think a lot more to come in payments that, and it's sort of this like holy grail that everyone's trying to do payments. PayPal was one of the big innovators of the sort of fintech era, but like people have talked about payments. So like, do people really spend their Bitcoin? All these like sort of skeptical questions, and right to be skeptical, because it's sort of this like I said, this holy grail, meaning this giant important thing that people seek after, but they never quite find, right? In terms, and then they do occasionally find it. I think that's a big one to watch.
So my last question is, putting aside finance, putting aside payments, what industry do you see as being most affected over the next 5-10 years by the blockchain?
Yeah, this is a tough one. There's a lot of answers to this question there's tons of debate about what this is, right? I think one of the most famous ones that people were targeting was like supply chain management, because again, blockchains are ledgers. That's what they are by definition. Ethereum is built a computer on top of their ledger, and as have many, subsequent alternative layer 1 blockchains. So you can do more. So it's a ledger with a virtual machine slapped on it. Which makes it a really smart ledger, right? A ledger with a lot more programmability. Remember, there was all those commercials back in the day. IBM had a big, used to push this all the time on TV. It'd be like, we're working with Maersk to like track tomato shipments across I think they shut that down, by the way. I always joke, like, when are we going to see that? And I saw that I think they halted maybe that, whatever that program or pilot or whatever. Yeah. And it's like, and I was like, oh no, how are we going to track the tomatoes? How are the coffee beans going to get tracked? Again, I'm joking around that was one that people talked a lot about. Tokenized. So outside of finance, tokenizing guess it kind of isn't finance, but tokenizing things, right? Tokenizing financial products, tokenizing real estate. These are all things that people have targeted, right? And there was a huge wave. I looked at in 2018, I think I met with more token issuance platforms than there were token issuances, right? This was a sort of white whale that you're searching for that could be a big use. I think we're making a lot of progress on that in terms of financial services. You've seen big GSIB banks do pilots on public blockchains or on layer 2s, tokenizing debt or tokenizing foreign currencies and trading them and whatever. That could be big too. Notice that I'm sort of saying these are things people think. I'm in the camp when it comes to what I consider enterprise blockchain, right? Well, okay, that crypto is like, okay, but like we really like that blockchain, man. Like private permission blockchains are not very interesting to me. And the reason is, it's that first reason at Fidelity, right? That the blockchain doesn't solve the problem, right? I mean, a lot of the stuff we said, Bitcoin is great because it allows two parties who not only don't know each other, but perhaps can't trust each other to agree on the settlement of a transaction. Well, in most business processes, you do know your counterparty. You probably have legal agreements, in which case it's like, shouldn't we just spin up like a database and then just agree to terms of how to use it, right? Permissioned database, wouldn't that be faster than relying on a decentralized network? But there are some interesting ones. And I think one that I'm very excited about, although it has to be done right, could either be extremely great or one of the most terrifying inventions in human history, would be digital identity. It doesn't necessarily need a blockchain, but it probably will end up using one. And my guess, there are some interesting things that the team at Square is building, which they I don't know, I think it's humorous, they call Web 5, say it's Web 2+3. Where you can use verifiable credentials, which don't actually require a blockchain. But I think it's very likely that some sort of portable digital identity will emerge, if not directly from the blockchain, then from the same, from the same sort of engendering of this whole movement, this cryptographic public expanded use of cryptography. I think if you can create a using zero knowledge technology, a way to selectively share information as needed, rather than, the classic example people use is like you go to the bar, you actually are only supposed to have to prove a binary question. Is person over 21? Yes, no, right? But instead I'm like, here's my home address. It's like, do I need to do that? Right. And so I think identity could be a huge one. I think you'll see a lot of stuff happen. And most likely a lot of it will happen on blockchain.
Awesome. Alex, thank you so much for joining us here in the CEO Blockchain series. Look forward to seeing you in the future and learning more together.
Yeah, thank
Have
you
a
so
great
much,
day.
Dan. You too. Great to be here.